Hello, aspirants. Welcome back to our YouTube channel, Smart Preparation to Success. As a part of our Tgpsc group and daily answer writing series, today we are going to discuss day 83 and 84 answers. Let's start. First question. Non-banking financial institutions have transformed the credit landscape in India. Examine their contribution to financial inclusion and inclusive growth. Non-banking financial institutions regulated by the Reserve Bank of India provide financial services similar to banks but are more flexible. Bajaj Finance provide consumer loans EMI. Muthoot Finance gold loans to rural and middle class families. Help small borrowers and increase credit access. Role in financial inclusion. NBFIs helps more people get access to financial services. They reach rural and remote areas where banks are not available. They give small loans to farmers and small workers. Microfinance institutions help women and low income groups. They have simple procedures so loans are given quickly. Role in inclusive growth. NBFIs support overall economic development. They provide loans to small business, creating jobs. They support infrastructure and housing development. They help people buy vehicles and consumer goods, increasing demand. They promote balanced regional development. Challenges. They face financial risk and liquidity problems. Some have bad loans. They depend on banks for funds. There is a risk of less regulation. Conclusion. NBFIs plays an important role in increasing access to credit and supporting growth, but proper regulation is needed to make them stable and safe. Second question. Differentiate between banks and non-banking financial institutions. Why are NBFIs considered both complementary and competitive to banks? Banks and non-banking financial institutions regulated by the Reserve Bank of India are important parts of India's financial system. While both provide financial services, they differ in structure, functions, and regulations. So, banks accept demand deposits, forming part of money supply, cannot accept demand deposits. Integral to integral to payment and settlement systems. No direct role. Capable of credit creation. Limited role in credit creation. Regulated under Banking Regulation Act. Regulated with relatively higher norms under RBI Act. Universal banking function. Specialized financing. Core to monetary transmission. Supplementary but increasingly system. NBFIs complement banks by addressing structural deficiencies in the formal banking system, bridging credit gaps in MSMEs, agriculture, and informal sectors where banks face risk aversion, enhancing last mile connectivity, especially in rural and semi urban regions, sector specific financing such as infrastructure, NABARD, MSMEs. Deepening financial inclusion through innovative delivery models. NBFI's competitive pressure on banks. Operational efficiency and faster credit delivery, leveraging technology and lean structures. Product innovation, particularly in retail and consumer finance. Risk based pricing and flexible lending norms, attracting undeserved as well as prime borrowers. Conclusion. NBFIs exhibit a dual character, complementary in expanding the reach and depth of finance at competitive in efficiency and innovation. This interplay enhances overall financial sector dynamism but necessitates a calibrated regulation to mitigate systemic risk. Day 84. First question. Discuss the major banking sector reforms in India and assess their impact on financial stability and inclusion. Banking sector reforms in India began with the 1991 economic liberalizations aiming to enhance efficiency, stability, and global competitiveness over time. Reforms have shifted from regulatory strengthening to structural transformation and financial inclusion. Banking sector reforms. Nasimham Committee reforms. Reduced SLR CRR. SLR means statutory liquidity ratio, cash reserve ratio. Introduced careful norms, emphasis on capital adequacy and autonomy to banks, banking regulation and supervision, strengthening of the RBI oversight, implementation of Basel norms for risk management, financial inclusion and initiatives, Pradhan Mantri Jan Dhan Yojana for universal banking access, expansion of digital payments and direct benefit transfer, insolvency bankruptcy code, time bound resolution of NPAs and stressed assets. Bank recapitalization and consolidation. Infusion of capital into PSBs and merger of banks to improve efficiency. Introduction of new banking models. Payment banks and small finance banks to deepen inclusion. Impact on financial stability and inclusion. Improved asset quality and reduction in NPAs, strengthened capital base and resilience of banks. Increased financial inclusion through mass account opening. Growth of digital financial ecosystem. Challenges. Rising NPAs in certain sectors remain a concern. Governance issues in public sector banks. Uneven access to credit in rural areas. Conclusion. Banking reforms have significantly enhanced stability and widened inclusion. However, continuous reforms focusing on governance, technology, and credit delivery are essentially to sustain long term financial health and inclusive growth. Second question. Explain the various quantitative and qualitative tools used by the Reserve Bank of India to regulate credit in the economy. How effective are these tools in controlling inflation and promoting economic growth? The RBI regulates credit in the economy to ensure price stability, adequate liquidity, and sustainable growth. It uses both quantitative and qualitative tools of monetary policy. Quantitative tools. This affect the overall supply of money and credit. Repo rate at which RBI lends to banks. Higher repo reduces borrowing and credit. Reverse repo rate absorbs excess liquidity from banks. Cash reserve ratio portion of deposits kept with RBI. Higher CRR reduce lending capacity. Statutory liquidity ratio banks maintain liquidity assets. Control credit expansion. Open market operations buying selling of government securities to regulate liquidity. Bank rate long term lending rate influencing credit cost. Qualitative tools. This targets specific sectors and uses of credit. Margin requirements limits loan amount against collateral. Credit rationing limits credit to certain sectors. Moral suasion persuasion by RBI to influence bank behavior. Directives priority sector lending norms. Selective credit controls restrict credit for speculative activities. Effectiveness in controlling inflation. Quantitative tools effectively reduce excess liquidity and demand pull inflation. Cost of push inflation is less responsive, promoting economic growth. Lower internet rates encourage investment and consumption. Qualitative tools ensure credit flows to priority sectors like agriculture and MSMEs. Conclusion. RBI's credit regulation tools are crucial for macroeconomic stability. While effective in managing liquidity and inflation, their success depends on timely transmission, structural reforms, and coordination with fiscal policy. So, these are the four answers. For daily videos, please like, share, and subscribe my channel. Thanks for watching.